Hello and welcome everyone to another wonderful webinar brought to you by Layton. My name is Judy Olivenza and I'm joined by Megan Boyda. We will be moderators for this online event today. Your host is Maggie Crowley, Head of Partnerships for Layton USA. We are incredibly thankful you've joined us for today's webinar, Boosting Real Estate Tax Strategies for CPAs, Cost Segregation, and Energy Efficiency Incentives. Our amazing presenters today are Rom Neidhardt, CPA, and Mark Bacon, PE. Prior to commencing this webinar, we are going to cover a few housekeeping items and technical checks to ensure a great learning event. If you are experiencing any technical issues, please let me know via chat message, or you may refer to the quick reference guide document that can be accessed from the materials section of this webinar in the top right corner. The questions pane is also where you can submit questions or comments to our presenters. This webinar qualifies for 1 CPE credit. This credit will be available within 24 business hours, and you will be notified at the email that you use to register for this webinar once the credit is issued. To earn credit for today's webinar, you must stay logged in for 50 minutes and answer polling questions. There will be 5 polling questions today, and to earn credit, you must answer at least 3 polling questions. Please be informed that today's webinar will be recorded, and if for any reason you get disconnected from this webinar or need to log out and log back in, the webinar software will keep track of your time. We recommend that you download today's presentation materials, learning objectives, along with a quick reference guide document, which can be found in the materials section of this webinar. Now I'll turn things over to Maggie Crowley for introductions. Maggie, you now have the floor.
Thanks, Judy, and hello, welcome everyone. Thank you so much for joining today. I'll run through our agenda really quickly on the next slide. The first thing that we'll do is just learn a little bit about why Layton is here presenting to you. I'll keep it very brief. We'll run through cost segregation by Rom, and then 179D tax deduction and 45L. So this will be brief, but hopefully very educational. Oh, sorry, and investment tax credit, ITC. So a little bit about why we're here, giving you the information today and why you should trust and believe it. We are one of the largest providers of commercial real estate tax incentives in the US. We have an amazing team of 20 plus engineers and CPAs and enrolled agents that are trained to the highest standard of tax code compliance to ensure accuracy. And obviously we want to make sure if there is anything where the IRS challenges it, that it's going to be easy breezy for our clients and partners to get through that. And we've been at this for a while. Layton as a firm has been in business for 27 years. We have done in the US over 10,000 cost seg and energy incentive studies. So we certainly bring our experience to every webinar and every engagement that we have. And we're happy to be able to share some of that insight with you today. So as you've heard, I'm Maggie Crowley, Head of Partnerships. I have been in the partnership business for about 15 years. And I've been with Layton for about 8 years. And I head up our relationships with CPAs. So if you're not currently a partner, we'd love to chat more about what that means. And if you are a partner, well, thank you very much for the partnership. And I'm joined today by our 2 experts, Mark Bacon, and we call Romulus Rom.
All right, well, I'll go first, Rom, and then you can introduce yourself. So thank you for the introduction, Maggie. My name is Mark Bacon. I'm a licensed professional engineer. I've been in the energy efficiency space for about 10 years. Very interesting spot we're in. It's basically the intersection between tax and engineering, which is fairly apropos because we have me as an engineer and Rom as a CPA. So it's the way I tend to explain it to my CPA partners is tax code is really broad. It's not reasonable to expect that you know everything. And what happens is companies like Leighton can go deep on particular topics like 179D and 45L, which are very much specialist skills. I used to work for Boss Adams, so I know what position a lot of you are in when it comes to your clients asking questions. Leighton can help you out on some of those deep dives. So that's effectively what we do. And as Maggie said, we've done 10,000 studies. So I'm confident if you got a question, we can find you an answer. And with that, Rom?
Sure, thanks, Mark. So we've had 2 attempts at my full first name, 2 almost hits on it. Romualdus is how you would pronounce it, but you can just call me Rom. So like they both mentioned, I'm a CPA. I've been in tax for about 7 years. Have been in commercial real estate, especially cost segregation that entire time for the last 7 years. Obviously, more recently, I've gotten more acquainted with 179D, 45L, working with Mark on the newer incentives. But as we'll kind of touch on later, I think cost seg is kind of the backbone that the newer energy efficiency incentives have kind of used as a jumping off point. So it's a good thing to kind of start out with, to kind of get an understanding for what we're looking at, how we're looking at it, and how we kind of apply it to your portfolio of clients, and start rolling it out and help your clients save some money with the buildings that they own. So excited to kind of chat through everything that we do here and see what we can learn together.
Well, thank you, Rom. And we're going to launch our first polling question. We'll keep it nice and easy. What made you register for this course? Why are you here today? So the options are just for CPE, to learn more about real estate and tax incentives, to explore cost seg and energy credits, to help clients reduce their tax liability, or maybe there's some other reason. Let us know. Well, I'm happy to see it's trending in the direction of to learn about real estate tax incentives. About 56% are here to learn. Also good that people want to reduce their clients' tax liability. I'd like for you to be my CPA.
Just a quick note, it looks like about 91% of you had voted. So just if you're away from your computer, just make sure you remember to vote on the other ones. I hate for someone to spend an hour here and then miss their CPE because they were off grabbing a coffee and they missed the question.
I think we have grace room to miss one, right?
Yes, we'll keep the poll open for 5, 4, 3, 2, 1.
All right, well, thank you. And I'll hand it over to, I believe, Mark to get us started.
Yep, definitely. So, everybody, thanks for the time today. Thank you for being honest. I know a lot of people are here for the CPE credit, so we'll try to do our best to keep it interesting for you. Hopefully you'll learn a little bit today. But what I'd like to start with is this slide because it basically explains everything I'm going to talk about. So it also explains cost segregation as well. So there is a lot of incentives out there for people who do commercial real estate. The reason for it is commercial real estate accounts for about 40% of energy use in the US. So if you want to reduce energy usage, if you want to reduce dependency on foreign energy or whatever else it may be, one of the fastest ways the government can do it is to incentivize people using tax incentives. Now, the one hopefully a lot of you are familiar with that Rom's going to go through in more detail is cost segregation. So I won't go through that in huge detail, but cost segregation is basically separating a building out to its individual components and taking accelerated depreciation on them. Fundamental concept is money today is worth more than money tomorrow. That is the big brother of all of this. If you're familiar with cost segregation, then you're familiar with the mechanism I'm going to talk about for 179D, 45L, and 48 for the ITC. All of them rely on accelerated depreciation. So you reduce basis to take basically value up front. So as Rom goes through that, just keep that in mind. That is the building block. The best metric we have, you ignore everything else that me and Rom say for the rest of the day, is if you have a client who does cost segregation, they should also do these other incentives. So that is the litmus test for us. If you like what Rom said, then call me later, basically. If there's one thing to remember, that's what you need to remember. So at a high level, the incentives. 45L is for any of you who have residential developers as clients. It is a tax credit based on per dwelling, or another way to look at it is per door. So a multifamily complex with 300 units is going to be a 300 unit complex. It's for energy efficiency implementations. The key here is when we say energy efficiency, we're actually talking about very achievable targets. We're comparing to IECC 2006 on a lot of these standards. Starting in 2023, we're using Energy Star. That's a bit of a different story, and we can talk about that later. But the idea is, how much more efficient are you than this 2006 building? So very achievable target. It is worth up to $2,000 a unit for any residential unit placed in service before January 1, 2023. After 2023, through the Inflation Reduction Act, it goes all the way up to $5,000 per unit. Now, $5,000 per unit requires zero energy ready homes. A $2,500 credit will require Energy Star building. That in and of itself is fairly complicated. Those are both very prescriptive programs. So you want to engage a provider like Layton early in that. But the high level view is $2,000 per unit all the way up to $5,000 per unit. So if you have a client who's doing any residential development, you're probably going to want to look at this. The cousin to 45L is 179D. 179D and 45L both been around since 2006. They're part of the Energy Policy Act of 2005, so we're safe there. 179D is a permanent part of the tax code. It was made permanent in 2020. So before that, I've been working in the space for 10 years. You may do some quick math and realize 10 years goes back before 2020. So what that meant for me when I was working on 179D is every few years, I basically lost my job when it expired. So if you haven't leveraged 179D, it might be because it was not necessarily a great thing to do from a tax planning purpose before 2020. So if you haven't heard of it, that's fine. Now it is permanent. Now you should be talking to your clients about it, and you should be leveraging that for tax planning purposes because it is a great incentive. So it is worth up to $5.81 a square foot. The idea is to use that to incentivize people to build more efficient buildings, so upgrades, whatever it may be. You can go back and take it retroactively. Same with 45L. 45L being a credit, you can only go back 3 years. 179D being a deduction, you can go back as long as basically all the way to 2006. So Inflation Reduction Act moved it from being worth $1.80 per square foot all the way up to $5.81 a square foot. So 2.5 times multiplier. Inflation Reduction Act was very helpful there. Cost segregation, I already mentioned. I'm not going to go through that in detail. The last one to consider for your clients is you hear the word solar, wind, geothermal. Any of your clients mention any of those words, they may get this clean energy investment credit. This is a big one. It's worth somewhere between 30 and 70% of the cost basis of that project as a tax credit. Massive. So it's actually so big that when someone came and quoted solar on the roof of my house, they include that right in the ROI calculations. When they go look at what is the cost of putting solar on, they're going to tell you about the 30% tax credit. So the good thing with investment tax credit is you can sell the credit. So if you don't have the tax appetite, you can actually sell it. So I would really recommend, and I'll just give you a list of keywords to think about when your clients are saying it, but ITC, hugely useful as you go through that. So I basically gave you an overview of what we're going to tell you for the next, how long do we have left? 46 minutes. So this is, the classic thing. Tell people what you're going to tell them, then tell you what you told them. So I've told you what we're going to tell you for the next 45 minutes. And I think, Meg, you have another polling question for us.
Yep. We're going to make sure everyone's paying attention. Well, before we get into it, what is your familiarity with cost segregation? All right, we're at 77% who have voted. How familiar are you with cost segregation? And for the most part, the group we have here today has advised clients on it. The runner-up is I understand the basics. Everyone's heard of it so far.
Yeah, everybody's at least aware of it, it seems like. So we can kind of go over it relatively quickly, and then I can give Mark more time to do his thing.
We'll end the
If you
poll
have
in
questions,
5,
yeah,
4,
I'm sorry.
3, 2, 1.
Pop your questions in the chat, and we'll save time to answer them at the end. We'll also open the chat up to live conversation where you can talk at the end as well, even if we go over the hour. That's it.
Cool. So it sounds like most people are at least aware of what cost segregation is. You know, it's been around since the 80s, really. It's when they kind of said you could do this. You could segregate costs in a building, right? So what is cost segregation? It really is just boosting depreciation. At its core, that's all you're doing is you're taking depreciation from your building, maximizing what you're claiming, making sure you're getting every single dollar out of that building as you can as soon as possible to take advantage of the time value of money. The way you do that is by, a building isn't a monolith, right? So if you build or acquire a building and just drop it onto your depreciation schedule, it's going to depreciate for 39 or 27 and a half years, depending if it's commercial or residential. But a building really is just a collection of assets, right? It's not one thing. It's land improvement, it's windows, it's window treatment, it's flooring, carpeting, tiling, different types of flooring. It's all kinds of different things that make up a particular building. And so rather than treating it as one thing, we segregate those costs. It's a very literal name, and make sure you're depreciating them correctly by placing them into the correct buckets. So any property owner could potentially benefit from cost segregation. We'll talk a little bit about who we look at, what our kind of rules of thumb are typically for a cost segregation study. But you can do cost seg if you recently bought your facility or renovated an existing building, right? So there's a big CapEx. You dropped a bunch of money into either buying a building or fixing up a building. Now you want to go make sure that it's all categorized correctly and you're depreciating it correctly. You have to make sure that it's for commercial use, right? You're generating income from that building, so you can't just do it on your house. You're not generating income, so you can't depreciate your house. So it's a commercial property. If it's a rental property, whether it's an apartment block or it's a single family house that you're renting out, or it's a storage facility, anything that you use to generate rental or generate income from, you could potentially look at cost segregation. And then there's assets within that project, right? So there are some buildings that are better than others for cost seg. If it's just a big wide open facility, there's nothing in that building, there's not a whole lot going on, electrical, HVAC, anything like that, it probably is mainly going to be a 39-year asset, right? It's just kind of the structure, so there's not too much there. So it really kind of depends on the building you're looking at, how much benefit you're going to get. But the times that we come across a building where there really isn't too much of a benefit to be had is rare compared to when we can. So if you go to the next slide, how does it work? So it's really just a three-step process, right? So buildings depreciate over 39 or 27 and a half years, depending if it's commercial or residential. Depreciation is slow. You get a little bit of that value as a deduction every year of the life of that asset, but it's going to take forever, right? How many businesses do you know stay in business for 40 years, right? So it takes a long time to get that value out of that building. So you take that building and you break it up into those subcomponents like we talked about, right? So you take an engineering-based approach. It's not just kind of willy-nilly. There are there's some strategies you can take if you're not interested in a full study to try to use historic percentages, kind of rule of thumb it. But generally what we do is an engineering-based study where we identify what actual type of flooring is in there, for example, whether the electrical, the HVAC systems are in there for specific purposes as opposed to just kind of operating the building. If they're there for decorative lighting, or if they're there to service a particular piece of machinery, right? The amount of that electrical system that applies to that piece of personal property as opposed to just the structure is what we're trying to identify in that step. Then you identify the unit level assets within that building and you have them in discrete listings so you can identify the depreciation, the depreciable class life that each individual asset should really be in. Right? So then you take that last step. You recategorize those assets into their appropriate depreciable lives, and you take advantage of that accelerated depreciation, right? So instead of everything being in that 27 and a half, 39-year bucket, you now have personal property depreciating over 5 or 7 years, or land improvements, or QIP, qualified improvement property depreciating over 15 years. So just even without bonus depreciation, which is kind of a hot button topic right now, which doesn't happen too often in accounting and cost segregation, they have a hot button topic to talk about. But even if you didn't have bonus, even if you didn't have 179 expensing, you're still accelerating from 27.5 to 39 years to 5, 7, 15 years, which can increase how much depreciation you're taking. Then you layer in bonus depreciation, right? So you can take bonus on anything with a class life 20 years or less. So everything that we drop into that personal property bucket, those land improvement buckets, you can use bonus depreciation, whatever that percentage is in a given year. If it's 100%, like they're talking about bringing back, or if it's still 60%, 40%, 20%, like it is at the moment. And that's just bonus on, it's a good name, bonus depreciation. It's just bonus on top. So that's it. It's relatively simple. The theory behind it is simple. The application is where it gets tricky. You need the engineer to look at the blueprints. You need them to look at the architectural drawings. You also have to understand the case law behind it, because there isn't just a single tax code you can look to that will dictate whether a piece of one individual asset is going to be 5, 7, or 15-year asset. So that's the process in a nutshell. So we can go to the next slide. So who do we apply cost segregation studies to? We use 3 criteria as our rule of thumb generally. So we need to know that the asset is going to be held for long term, right? So if something's going to be accelerated and then sold in a year or two, you're going to be subject to depreciation recapture. So there's not a whole lot benefit there. We have had clients that wanted to take advantage of it, even with the plan to sell within a couple of years. If the building's big enough, there's a big enough chunk that you can get out of that building and reinvest for a couple of years that it's worth paying that depreciation recapture. But generally speaking, for most people, at least 3 to 5 years hold period is what we want to see for cost segregation to be worth paying that recapture on. The second criteria is we need to cost more than $1 million typically to acquire or build. That is very much a rule of thumb, right? So that's not a hard rule. The benefit of cost seg is a percentage of basis for accelerated depreciation. So if you're taking 80% of only $20,000, there's just not enough there to be worth your time. So we typically look at $1 million or $300,000 for just a renovation. And it's a lot smaller, but it's because you can take advantage of qualified improvement property, which you can't on a new build or an acquisition, right? So if you have qualified improvement property, there's a lot more there that you can bonus out, so that basis number can be a little bit smaller. And then the third is, there needs to be a range of building systems, right? So like we talked about, if we're just looking at a big storage facility, a big warehouse, it's just 4 walls, a roof, and a floor, and there's not much going on there. There's not much to accelerate. So we want to see more complicated buildings. Apartment buildings are kind of the standard, right? Apartment buildings have a lot of different flooring types. They have decorative lighting. They have HVAC for different systems for a pool, for example, or electrical systems for your gym. There's just more stuff going on in there. So you want to see that there's something that you can identify and accelerate at some point. And then as our last slide for cost seg before we move on, we'll just talk through a quick scenario for a client we saw recently. It was a great example of a cost seg client. They were kind of, they were the perfect cost seg client. I love them. They're a meat distributor, so they're meat processing and distribution. So there's a lot going on in their facility. So they offer premium beef, poultry, seafood, and pork from this facility. The building itself had really 3 kind of phases. They had the office where the people worked, right? So an office building has its own kind of set of assets, from removable carpeting. You have to have outlets in certain positions so you can have a laptop plugged into it, as opposed to just kind of running a normal building. Then they had the processing floor. So when you're processing beef, right, a cow weighs a ton, you're going to have cranes overhead. You're going to have all kinds of forklifts and all big equipment that needs specialty electrical, specialty HVAC in that processing facility. So there was a lot to take from the HVAC and electrical systems in that section of the building. And then lastly, there's cold storage, right? So once you process that meat, you don't want to just throw it out in the sun, right? You're going to want to keep it cold. That third section of this building was for refrigeration, right, and cooling. And so that is very specific HVAC. There's all kinds of case law you have to look into to make sure that you're handling that correctly. There's the Piggly Wiggly grocery store was a big case where cold storage and whether that was specific for a particular process or just running a building for cooling, they have to take a look at. But at the end of the day, the benefit to this client was $3.6 million in year one depreciation. So, it's a big dollar amount for a client that they could just turn around and use that to reinvest in their building, reinvest in other buildings, kind of expand their business, whatever it is. So they were kind of my favorite client. It was just the perfect case study for cost segregation. Yeah, that's it. So we'll move on to the next polling question.
All right. Thank you, Rom. Everyone, what is the biggest barrier to implementing these incentives? And I think Judy is about to launch the poll. There we go. And not just limited to cost seg, but other, any type of incentives. All right. Seems like the most favorable answer so far is cost and or uncertainty around return on investment, which makes our pricing structure and our structure pretty great. We don't actually lock anyone into an engagement until they understand what the return on investment would be. So we always provide an estimate before executing a contract.
All right. We're going to keep the poll open and close it in 5, 4, 3, 2, 1. Thank you.
Okay, all right. Well, it looks like I'm up to talk about our next few incentives. Like Maggie said before, please ask your questions. I guess as a frame of reference, I do these webinars all the time. They're way more interesting if you ask a question. So I will say we've got a few softball questions I can ask myself, but I always prefer it if you come up with something on your own. So with that in mind, let's start talking about 179D. So how does 179D actually work? As Rom said before, we're really talking accelerated depreciation. Specifically for 179D, it's for energy efficient commercial buildings. It is for the building owners originally. It was extended to the designers of government buildings starting in 2008. Now, why did they do that? It's because they launched 179D in 2006. It didn't get the uptick people were thinking. Like, not enough people were using the tax deduction. So the government said, who else owns a lot of buildings? Well, we do. So why don't we incentivize the architects and engineers who design our buildings? And we will be able to allocate the tax deductions to them. So really, really advantageous if you have any architecture or engineering clients. If they're working on any government buildings, they can leverage this. Now, architecture and engineering companies tend to run pretty lean, so tax incentives like this are extremely valuable to them. And then in the Inflation Reduction Act, the government said, okay, who else owns a lot of buildings? Nonprofits own a lot of buildings. So it was extended again to designers of nonprofits. So any of your clients who are designing government buildings or people who aren't paying taxes, you're tax exempt, you can potentially take this tax deduction and award it to the designer. So if you have any clients, architecture engineering firms, I highly suggest you look into this. Now, specifically, we are looking at a couple systems on the inside, and this is why cost segregation pairs really well with 179D, because Rom will come in and accelerate depreciation on things like your carpets and your cabinets. He can't touch your HVAC. I can. So I can accelerate depreciation on things like the heating, cooling, ventilation, and hot water systems. Generally, you can't, at least. And then like building envelope, insulation, as you can imagine, pretty much always going to be 39-year property. The interior lighting, so I don't worry about parking lots, but the interior lighting very often will stay as 39 years. So the way we like to explain it is cost segregation is a cake. It's going to get you the most of the benefit. 179D layers benefit on the top to the things that cost segregation can't do. So perfect example based on what Ron was saying, warehouses for cost seg may not be the best because there's a lot of stuff in there that's structural. I can do 179D in a warehouse from an energy modeling point of view. It's quite simple. It's a big open space. There's a few HVAC units. There's some lighting. Simple. It's not like down at the bottom, the most complex ones, like a hospital. As you can imagine, a hospital, a lot of rooms, a lot of different HVAC units. They have to keep their places clean. So when you go to check the energy efficiency of a hospital, it's a lot harder to understand than, say, a big open warehouse. Which kind of brings me to the point of why am I talking about how the building's set up? It's because the way 179D works is you have to do a couple things. So first off, the question I often get is, why can't the clients do themselves? Or as their CPA, why can't I do this? It's because the tax code says you have to have an unrelated licensed professional engineer or architect do the study. So it's the analogy I use is kind of like asking your barber if you need a haircut. The person who designed the building and built the building cannot tell the government it's energy efficient. You have to use a third party like me. And the way I validate that is by doing an energy model. So we are comparing this building currently to a 2007 ASHRAE building code. So we're in 2025 now. You can imagine a building built to code in 2025 is going to be a lot more efficient than basically a code building from 2007. So we create an energy model, we compare it, and we look at the percentage energy savings. The higher the percentage savings you have versus the 2007 building, the more of a tax deduction you get. Goes all the way up to $5.81 a square foot. So kind of general rule is the more simple the building, the easier to do it. When you get into things like hotels, hospitals, military bases, correctional facilities, they're really, really complicated. Definitely want to use someone who's done a lot of those. And I've been inside a lot of the military bases in the US and a surprising number of prisons as well. So I can tell you there's a lot of complexity involved in doing an energy model of buildings like that. So if for whatever reason one of your clients is working in one of those buildings, you definitely want to pick a provider who's done them a fair number of times. So we create the energy model, we do a site inspection. Those are both required by the tax code. Pairs really well with what Rom's doing because if we're going to do a cost segregation site visit, we can also do a 179D site visit at the same time. So you're able to kind of help with your costs there as well to say, okay, we want to accelerate depreciation. Let's accelerate as much as we can. We're going to do cost seg and 179D at the same time. So very advantageous to be able to pair those together. There aren't a lot of providers out there who do that. Just a quick heads up for you. Generally, cost segregation providers will take a run at trying to hire a professional engineer like me to do the 179D studies. Easier said than done. Very much a specialist skill. So there's not a whole ton of people who do this for a living. But yeah, that's kind of the high level of 179D and why you might be interested in it. Again, it is done on a per square foot basis. So that number I gave you, that $5.81 a square foot, I'll give you an example in the next slide, but you want higher square footages. So an example of what this looks like is a hotel. I mean, probably most of you have been in a hotel like this at some point in your life. This one's reasonably sized, about 70,000 square feet. It is 70,000 square feet. It reached the full deduction. The tax amount is actually inflation adjusted. So I said $5.81 a square foot. That's for 2025. If you go back to 2023, it keeps dropping down. And then if you go back even further, it's that $1.80, $1.88. So you'll see numbers range anywhere between $1.80 all the way up to $5.81 a square foot, kind of depending on energy savings and when the building is placed in service. So in this case, it's 70,000 square feet. They reach the full deduction of $5.36 a square foot. And that allows them to get a tax deduction of $371,000. So the square footage really matters. General rule of thumb is if your clients have buildings that are less than 50,000 square feet, if they have enough of them, we can go down to about 20,000 square feet. It's not a restriction on Layton's end. It's really a restriction on the ROI for your client. If you drop into the 20, 30,000 square foot buildings, you can go and do a whole 179D study and their net benefit is going to be $5,000, $10,000. Like it may not be worth it for a lot of clients. So general rule of thumb, as I say, 50,000 square feet. If you get a client with a building that's 50,000 square feet or more, probably want to look at 179D. So that's kind of the high level 179D. It's I guess for a frame of reference for everyone here, there's so much we can go into on this. I did a 2-hour webinar just on this. Like that's it, 2 hours CPE credit only on this topic. So if you want to dive deeper into it, we can definitely help you out with that. But obviously, we don't want to spend 2 hours talking about this today. So I think with that, we are going into our next polling question.
All right, everybody. Thank you, Mark. What percentage of your clients own a commercial property? 0, 1 to 25, 26 to 50, 51 to 75, or over 75%. It looks like the most common answer is the 1 to 25% of their clients own a commercial property. All right, we have got 85% who voted. Get in here and vote. Get your credit. This one's a
And a
really easy
friendly
one.
reminder that in order to receive CPE credit for this webinar, you must respond to at least 3 out of the 5 polls. And this poll will be closing in 5, 4, 3, 2, 1. Thank you.
All right. Well, thanks everyone for answering that question. Just as a side note, I will say I spoke to a group of CPAs last week, and there was 60 people in the room, and I asked how many of you have clients who own a building, and only one hand went up. So it made it for a fairly long presentation when I knew that nobody in the room actually had clients that could leverage this. So just a heads up for everybody, as long as you have a client, this is definitely something you can use. It sounds like most of you have at least one client that is worth bringing this up for. So with that, I will continue on to our friends over in the residential space. So residential space, we are talking about residential developers, as I mentioned before. Anything before 2023, so pre-Inflation Reduction Act, you would get a tax credit of up to $2,000 per unit for every unit that you put in service. Now, it required just a fairly, I don't want to say basic, but it required a HERS rater to come out and basically validate the building through blower door tests and duct leakage tests to make sure it met certain energy savings thresholds. So relatively simple to do. You could go find a HERS rater and get that done. So there are a lot of providers who did 45L. Now, what happens is Inflation Reduction Act comes along. Inflation Reduction Act requires you to be compliant with Energy Star. Energy Star is much more prescriptive. So a lot of those same providers who were doing 45L basically backed out of the market. Now there is a statute of limitations on what we're calling legacy 45L, which is the easier, arguably easier one to do. It doesn't require Energy Star. You've got 3 years from the tax year in which the building was placed in service to go back and claim the credit. So you can go back and amend your return. So if you have any clients who did multifamily buildings, look back 3 years and see if they're still eligible for this. So if they placed in service a 200 unit multifamily complex back in 2022, you're going to want to look at 45L right now, because once that statute of limitations is up, it's gone. We can't go back and retroactively claim it. Looking forward, though, Energy Star. Energy Star is interesting, and I'm waiting for someone to ask the question about the fate of Energy Star, but I'm going to hold off until someone asks. But Energy Star is a much more prescriptive requirement. Energy Star did require you to do a lot of things, like random things you might not think about when you're building, like drywall gasketing, which is basically something in between where the edges of drywall come together, like the edges of the room there you can see behind me. You had to have gasketing in there, which means you had to have some form of barrier. Now, that's a $20 tube of caulk from Home Depot. And if you miss it, you cannot get Energy Star. And if you do not get Energy Star, you do not get 45L tax credits. So it got a lot more complicated, which is why a lot of people left the space. We have people on staff who are experts in Energy Star and Zero Energy Ready Homes and Passive House. So we're able to help our clients work through that to ensure that they're able to hit the tax credit. So what does this mean for you? If you have a client who's building and they may or may not be familiar with what Energy Star is, it's not that hard to achieve in a lot of places based on what your building code is. So for example, if you're in Colorado, pretty good chance you're going to hit Energy Star, whether you're calling it that or not. Or if you're in Massachusetts, you're definitely going to be in the range of Energy Star. Your clients may simply not be talking about it. Now, if you call up our team, we can tell you how close you are to Energy Star. So back to Maggie's point from before, kind of low risk here. If you've got a builder who's doing multifamily, give us a call. We can look through the plans and no charge for it to tell you, hey, you're pretty close to Energy Star. You should tell your client to invest a little bit more money so they can get this certification. Um, don't just do Energy Star for the 45L credit. Energy Star gets you things like lower interest rate mortgages. It gets you higher rent rates. It gets you higher resale value. All of these things that come with that Energy Star label or any really resilient building label, Energy Star, LEED, Green Globes, those get you a ton of benefits. So we've kind of been steering our clients to say, look, you really, really should be doing things like Energy Star. It helps you way more than just a tax credit. So if your clients are doing that, please reach out to us. Type of buildings that qualify, I mean, there's a list there on the side that you can read, but basically multifamily, single family home developers tend to forget about 45L, but it's really valuable. The key is you have to have basis during construction. So you actually have to be an owner while the building is being built. So that is the key distinction from a tax point of view to keep in mind. You can't just fly in later, buy the buildings, and then take a 45L tax credit. You have to own, you have to have basis in it during construction. And what does this look like? Just as a quick example. So single family home developer, again, they're probably pretty underserved because a lot of people aren't talking to them about tax credits. This was a client that had 64 units. So it says 55 homes. Just a heads up, there are single family homes there, but there are also townhomes and there's a multifamily complex in there. So this builder had a variety of single family homes, townhomes, and multi-unit complexes. So 64 of their units qualified for the tax credit. That got them a tax credit of $128,000. Now, obviously, fairly valuable for the direct client. So with that, I'm going to pivot here over to investment tax credits. And we don't have a polling question in between these, but we're going to have another one right after it. So investment tax credit, Section 48 or Section 48E. If you have heard about it, it's exactly because of what I told you before, probably solar. Solar is, a big thing for everybody right now. So investment tax credit helps make that more affordable. So ITC is for energy efficient renewable systems integrated into commercial buildings. It goes anywhere between 6 and 70%. But you may notice on our first slide, I really said between 30 and 70. There's a big reason for that. It's because you get 6% if you don't meet prevailing wage and apprenticeship requirements. But a lot of investment tax credit studies are exempt from that because of the size of the study. So you automatically qualify for the prevailing wage and apprenticeship waiver, which I'm going to show you here in a second. The projects are really focused in, and I'm going to give you a list of technology. If you don't remember anything else about ITC, all you need to do is really look at this list of things and say if your client have ever mentioned any of these, they should be doing ITC. But at a high level, solar, wind, geothermal, any renewable energy. And as promised, here are the energy pieces. So the really nice thing about an ITC is basically 179D, 45L, cost seg. You have to have some form of tax liability to offset. You cannot transfer the credit. ITC, you can. You can go sell it on the open market. There are a few providers out there that do that now. It used to be a hodgepodge of you had to know a guy, basically, in order to be able to sell your ITC credit. Now you can actually, there's basically a marketplace for it now. So if you've got a nonprofit client, you can go sell the investment tax credits. And we're working with clients who are doing that right now. So this goes on basically 2023 and on. A couple technologies to keep in mind. I've already highlighted some of the main ones, solar being the main one. But if your clients are talking about any of these things, geothermal is actually a really interesting one here, the fourth bullet point down. Depending on where you live, geothermal is an incredibly efficient technology for heating and cooling a building. If your client can put geothermal in, they're going to save a lot of money over the length of the building being in service. Geothermal is really interesting for ITC though, because a lot of investment tax credits are relatively simple. You basically are looking at the cost basis and then figuring out whether or not the bonus adders apply, which is on my next slide. And then let's say, for example, you did a solar project for $300,000. You can easily define the $300,000 cost. You take that $300,000, you think your client's eligible for 30%, you give them a $100,000 tax credit. That's simple. So if you've got a client who has all the information, all the cost basis, everything, the permitting information, everything you need in order to qualify the cost basis, you might be able to do ITC yourself. Some CPA firms do it. It tends to be the larger CPA firms will do ITC themselves. However, I don't recommend any CPAs do a geothermal study on their own, because in geothermal, you're now talking about an engineering study. So there's a line on ITC where there's a tax study and then it gets into the engineering study world. Geothermal is where that happens. In particular, when you start looking at combined heat and power plants, for God's sakes, don't try to do ITC on that yourself, because you're talking about steam, turbine, water reuse. Like there's a lot of engineering things there, and you have to look at the actual purpose of it, the dual use purpose. It gets very complex. So solar, a lot of CPAs will do that on their own. The others, I would recommend you go to a specialist. Now, obviously, I am a specialist, so take that with a grain of salt. But you will see, I have seen enough people try to do geothermal themselves, or fuel cells, for instance, get really complicated very quickly. We have a number of clients who have tried to do that themselves and then eventually called us. So that is the high level view. The other complexity with investment tax credits are the bonus adders. Now, the bonus adders, and this will allow me to talk just a general discussion around some of the things that came with the Inflation Reduction Act. The bonus adders are complicated through the investment tax credit. So if you want to get, ITC starts at that 6% base credit. If you are paying prevailing wage on the project, and if that project has an apprenticeship program in place, you get a 24% addition, so 5 times multiplier. That brings you all the way up to a 30% tax credit. The challenge there is prevailing wage is a bit of a pain. There are websites you can go to, sam.gov, and you can go see, okay, an electrician on this project should make in this county $17.13 an hour. You can go check that. Real pain to go do that. The actual big problem is apprenticeship programs. Apprenticeship programs have been a real challenge to document. Fortunately, any project under 1 megawatt is exempted. So rooftop solar is probably almost always going to be exempted unless you have a massive building. Geothermal, very likely to be exempted unless you're working with very, very large buildings. So you're probably going to get that 30% tax credit. Where it's going to get a lot more complicated is, a lot of you may see a push for domestic content. That is very big on the agenda in politics right now. Domestic content is really hard to prove because solar, as you can imagine, most panels are not manufactured in the US. So you are not going to get that 10% credit for solar. However, geothermal heat pumps may be entirely manufactured in the US. Now, you as a CPA, do you want to go chase down and figure out where the metal was mined for a geothermal pump? Probably not. So that's where part of the reason why I say you're going to want to go to a company like Layton is if you have to deal with domestic content, that's pretty hard to do. As well, if you move further on, when you get into low-income community, tribal lands, low-income residential project, economic benefit projects, those are all separate bonus adders. They require an application. You have to apply before you start the project. So there's enough complexity in there that you're going to want to kind of leverage some expertise on that one. So we did say the max credit goes up to 70%. I've never seen a 70% credit project. I mean, the stars have to align perfectly for that to happen, but it is possible. All right. And the last thing about investment tax credit is just to give you an idea how valuable it really is. So fairly typical 200 ton geothermal heat pump. As I mentioned before, they get a little complicated. $4 million. We were able to prove domestic content on this one. So they got the basically $4 million cost basis, 6% ITC, the bonus credit for prevailing wage, as well as the domestic content bonus. They were in an energy community. They get $2 million, so a 50% credit. They get $2 million tax credit on the $4 million cost basis. ITC is interesting because it only reduces your basis by 50%. So you get an additional benefit there. So the basis was reduced from 4 million to 3 million instead of 4 million to 2 million. So additional benefit of ITC. So pretty significant benefit to clients if you can leverage investment tax credits. All right, I think with that, I have been talking for a long time, and we have another polling question.
We sure do. All right. How likely are you to apply today's insights to your advisory services? I like the answers so far. Oh, very likely, likely. One thing I do want to mention is if people are unsure if their client qualifies, ask us. We're happy to let you know. We're happy to take the information that you can provide us and give you an estimate of what they'd be eligible for. We've had, I can share a case study. We've had some instances where people have just not looked into it and missed out on a huge benefit. So you don't want to be the CPA that doesn't look into it because you don't think it's worth it and then not be right.
All right, and this is the fifth and final polling question, which will be ending in 5, 4, 3, 2, 1. Thank you, everyone.